Welcome, investors, to the Absolute Return Podcast, your source for stock market analysis, global macro musings, and hedge fund investment strategies. Your hosts, Julian Klimachko and Michael Kesslering, aim to bring you the knowledge and analysis you need to become a more intelligent and wealthier investor. This episode is brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com.
Welcome, everybody, to the Absolute Return Podcast. On today's show, we welcome special guest Eva Yazhari, the general partner of Beyond Capital Ventures, a women-led impact venture capital firm. On the show, we discuss the compelling opportunity for early-stage investing in Africa and India, how venture capital differs in emerging markets, what she looks for when investing in a startup, and more. So with no further ado, here's our show on VC investing in emerging markets with Beyond Capital Ventures, Eva Yazhari.
All right, welcoming Eva to the show today. Excited to chat about emerging markets investing. And it's a theme that has really picked up this year. You've seen just tremendous outperformance of international investing. There's just been so much focus on American capital markets and the Magnificent Seven over the past several years and the themes driving that people really forgot about the diversification benefits of investing internationally in what I find particularly fascinating are the frontier markets that you typically don't hear about, because when people think international investing, they think about maybe Japan and Europe. But Eva, you go way beyond that. So thanks for coming on the show. And to kick it off, could you chat a bit about Beyond Capital Ventures, what inspired you to launch the firm, and how does it differ from traditional venture capital firms?
Absolutely. Thank you, Julian. Thank you, Michael, for having me. Thank you for opening up the conversation to emerging markets as an opportunity. So Beyond Capital Ventures is a multi-strategy firm. We invest principally in venture. So venture is our flagship strategy, but we also have a credit strategy as well, recognizing the kind of maturity level of the markets where we invest. We focus on two of the largest emerging markets, India and East Africa, in one portfolio. You hit the nail on the head, Julian, by stating diversification. So not only are we looking to provide our investors with diversification for their own portfolios, but we also create diversification for them as an investor in two markets which are highly complementary and have 1 billion individuals rising consumer classes. In other words, demanding access to what we call need to haves, healthcare, financial technologies, financial services, mobility sectors which are also relatively resilient. So that's how we invest and where we invest. And there are specific nuances about what make us a little bit different than your traditional VCs. While our due diligence is very similar, we look at 70 companies oftentimes to invest in one deal. We have a below 2% selection rate. What makes us really unique is really three things. One is our portfolio management approach goes above and beyond. And I'm happy to unpack that for you later, but it really helps us ensure that we are investing consistently over time and supporting our companies towards growth and success. And that's been substantiated by 750% revenue growth since we invested in one of our more recent venture funds, which was a 2021 vintage. So very substantial revenue growth. The second area is what we call diversity of thought. That doesn't necessarily mean, I am a solo GP, solo female general partner. That doesn't necessarily mean DEI in the classical sense. It means diversity of behavioral styles. And we use the DISC framework to understand our founders' behavioral styles. We also use it to understand our team's behavioral styles to help the right person build the right solution to a problem that they are often in love with. And then finally, I'm always happy to unpack tech and AI in the portfolio. I think what's fascinating about tech and AI in emerging markets is the opportunities that it brings vis-a-vis like a Silicon Valley or a more developed market as well.
What I find fascinating about what you're doing is, as a solo GP, and when people talk about venture, they talk about the Sequoias and the A16Zs of the world. How do you operate as a solo GP? How different is that than the traditional VC firms that are constantly in the media that people more typically hear about?
I mean, I have a lot of respect for the large VCs who set the tone for the industry. I also came out of Wall Street. I worked in the fund of hedge funds business, and also I was employee number 2 in a fund of funds that we built on the investment team from 200 million to 5 billion in less than 5 years. And we were very entrepreneurial. And I do believe that A16Z and the other large firms have set the pace for VC investing and created this strategy. What's great about being a solo GP is you get to rewrite the playbook. And that is so fun. And frankly, you get to rewrite the playbook for the markets that you're investing in. So in my markets, we have a very differentiated innovation curve. We kind of call it like an S curve. And it's much steeper. The tails of the S are actually much longer. And then the kind of slope of the curve is similar to VC, but sometimes it just kind of takes a little longer to get there because emerging markets are lacking critical infrastructure or are in the process of leapfrogging critical infrastructure, but it just hasn't happened yet. And so sometimes our companies take a little longer than your average VC fund to play out. So that is one point of differentiation, but other areas are thinking about our investment portfolio allocation differently. So we don't believe in the power law approach. I have a 0.3% loss ratio across my venture fund investments, which is obviously exceptional over a 14-year track record. And the reason I have that number is because our portfolio approach is what we would call a little bit more, it's more concentrated, but it's more careful about where we put our capital. And we're not looking for one unicorn to return, to return a fund and then cover all the losses. We're really looking for a band of like 5 to 10x across our portfolio companies, of course, with a few losses, because then we wouldn't be taking enough risk, but that's still average to a very strong top quartile venture return. So that's another way. And then finally, I was sitting with a partner at A16Z recently at a lunch, and I was asking him about our strategy applying behavioral assessments to founders, assuming that A16Z gets to do that. And he said, we don't. Because it's so competitive where we invest, we just don't have the opportunity. We are looking at the investment opportunity. We're doing our due diligence, but we don't have the opportunity to get to know the founders from a different angle. And that is also an area where we've been able to go above and beyond because the room is there for us in the markets where we invest.
While the traditional VCs focus mainly on Silicon Valley, you're literally halfway across the world looking into India and East Africa, which is certainly non-consensus. Now, what is it about those markets that appeal to you?
Yeah. Well, my father grew up in Tanzania. So I grew up with a kind of a subconscious programming around East Africa and the opportunities there. I'm a New Yorker, but have, thought about being an American in a very different way. So that's number one. But number two, when I left Wall Street, every successful hedge fund manager at one time had what they call a contrarian bet. So I was kind of trained in that way of thinking. And, my contrarian bet was to use my skills, deep due diligence, portfolio construction, portfolio allocation, relational investing as well, and apply them to markets with tremendous growth potential. So where we invest as a $6.3 trillion total addressable market, for example. Innovation already embedded in the markets. I'm not sure if you're aware, but mobile money was born in East Africa. And I think we know a lot of the tech innovation that occurs in India, but also basis of the British legal system, as well as English as a, important language for doing business, because some things you just can't navigate if you can't communicate. Communication is at the core of everything we do. And so because those dynamics were present in East Africa, but I also wanted to diversify the portfolio with a much larger singular market like India, it made a lot of sense. If you look at the Western Indian Ocean region of our world, while it's vastly ignored by the investment community, 75% of the world's growth between now and 2050 will occur on the eastern side of Africa and in India. And so there's a tremendous opportunity to invest in the future of global growth and the future of the global consumerism as well, which again, when you start looking into tech and AI enablement, can be exponential. We have companies with $1 billion market for lending to smaller shops through a tech platform in Kenya alone. And in Africa, we have exposure across 13 countries. So we have local offices, just so you kind of get that framing. We've built a firm with a local presence, local team, and an expertise. And I'd say the last thing that really attracted me to these markets was that the valuations are much lower.
Right.
So we are not overpaying. And it seems nonsensical to me as an investor and a professionally trained investor to overpay, because you're then always playing catch up later on. And so in Fund 2 for us, the average valuation across from seed to Series A plus and occasional Series B investments, because we have the ability to bridge that spectrum, was $18.5 million. That's half the US Series A valuation. So I think that also says it all.
Yeah, it certainly doesn't seem like it's nearly as competitive compared to what you see at home base. Now, with that, investing in these frontier markets, I'm sure it comes with a ton of nuances and required expertise that you've built up over many years. Could you discuss some of these kind of more unique nuances of the markets that you've been traversing for a while?
Yeah, of course. Well, first and foremost, our Africa investments are all in U.S. holding companies, all in USD. And then, of course, from a structural perspective, we've gotten really comfortable, really fluent in the Indian investment landscape. So the types of structures, we have the right advisors, also in both areas, in both regions, we have the right advisors as well. So all of that is relatively de-risked. I actually have a lot of Indian Americans that give us their capital because they cannot comfortably remit their capital into their own home country. But we've been able to kind of cut out the compliance issues and we just deal with it. But I think what you're really asking for, Julian, is like, what are some of the trends that stand out in our investment strategy that we see as maybe being different or like misperceptions? So the reality is end-to-end tech actually doesn't work in Africa in particular. Tech-assisted models or AI-assisted models are really critical. An investor that comes in, but for Nigeria, which is a very different mature market, very insular, we don't originate deal flow there. We have a little exposure through other investments. But for Nigeria, the rest of the continent is largely requiring human assistance. The customer needs to be able to talk to somebody. They will not just like us, download Uber, get in somebody's car, not say a word and get out and pay. It's very different. The second area, though, I think we're always thinking about is replacement versus enhancement. So there's a lot of informality in the markets where we operate. There are a lot of small mom and pops that are relied upon for food or stationery or paint or you name it. Like, all the things we would buy in a Home Depot or that Amazon would deliver to us. There are mom and pops across Africa and India that are selling those goods. And we don't believe that replacing those smaller retailers is actually a good investment strategy. Enhancing those retailers is where the investment opportunity gets really interesting. But if you were to just fly in and look at the landscape, you would say, this is inefficient. Why are there 10 stationery stores next to each other? We need to consolidate all these and start a big chain and scale it. It's just not the way that in particular Africa operates. So when I think about a risk, I think the risk is really in implementing the wrong investment strategy. All of the other risks, whether they're currency or political risk, or again, structural risk, can be mitigated with the right level of experience.
And just to drill down into that a bit more, you mentioned valuation as a difference between some of the emerging markets on especially the seed side and Series A versus North America. But Can you describe a little bit of some of the other differences, especially from seed to Series A? Would you find that it's a longer time between seed and Series A? Are then the Series A valuations or targets a little bit different? Just how that process of going from seed to Series A in emerging versus North America?
Yeah, sure. I would say in terms of duration between and time between seed to Series A, not in this environment, but in the 2020, early 2020, 2021, like in the hot markets, in the bull markets, absolutely, there is a difference between seed to Series A. But in this environment, I think everybody's kind of raising capital at a very similar pace. It may be the growth stage where in Africa, some of the funding slows down, investment slows down later on. But when it comes to the quantums of those rounds, India is probably sitting at valuations that are 70% of the US, but India also, mirrors Silicon Valley quite significantly. I mean, some people say that India is 10 years behind the US. I think India is catching up, and maybe, every quarter I refine that to be 1 year less because they're moving so quickly. Africa, though, I would say is about 40% of US valuations, which is why our average is also so good. In India, while we haven't overpaid for anything, the valuations are often higher than Africa. And and in terms of revenue, though, we see that companies actually have greater product market fit and stronger potential for revenue, stronger looking unit economics, as they're scaling from seed to Series A and Series A to maybe like a Series A, bridge to B round vis-a-vis the US. We don't fund pre-seed, so we don't fund pre-revenue, so we don't really see that much there. I mean, we of course see the companies and we stay in touch with them, but we notice that typically their revenue trajectory is much more impressive, and what that has resulted in for us are 100% graduation rates across our last vintage fund. In addition, we've had portfolio companies that about 7 out of 16 are now profitable or EBITDA positive, which is somewhat unprecedented for an earlier stage fund. So we see that the trajectory to profitability also looks better in our markets. And a lot of times that is different expectations from investors.
In terms of the themes that you're focused on investing in these markets, you mentioned that they could be, you look at the US and they're several years behind. Is it a matter of seeing what's worked domestically and looking to repeat that? Or are these themes completely different in terms of the opportunities that you're capitalizing on?
I don't want to say they're completely different, but they're definitely different. And the perfect analogy and way to describe this is to tell you about one of our portfolio companies called Ampersand. Ampersand is East Africa's leading e-mobility business. The company started establishing and manufacturing two-wheelers. So your most prevalent vehicle is a two-wheeler. In Africa, in India, they're actually different in both markets, believe it or not, but we can nerd out on that at another time as to why, because they needed for different uses. But Ampersand started manufacturing two-wheelers, and then they quickly realized that their business model was not about manufacturing bikes. It was then also creating the battery technology and building the battery swap networks. But if you were to come from the US or Canada, North America or Europe, you would think charging stations. You would think plugins at home. And the rider who is typically driving for Uber Eats or another gig economy company doesn't have a plug in their home. They don't have access to the grid, particularly the grid at that level. And so the battery swap is really, really important for that business. And it's actually the key innovation. In fact, now more than half of the company's revenue comes from battery swapping, which is what we really wanted to see when we had originally invested in the company. But I think that's the perfect anecdote to share, that the models are not completely different, but the needs are very different of the markets. And I don't know, I haven't done this research, but I'll pose the question. In the US, is the Tesla driver or the EV driver, are they driving that because of cost savings, or are they driving that because they believe in climate as a strategy? Because in Africa, the driver does not really acknowledge the climate impact of their daily life. They only care about reducing their costs, and ampersand's bikes and battery swaps reduce their costs by 50%. So that's also a little bit of a different mindset shift. I have an electric vehicle. It's great. I like it. I kind of feel good about driving it, but I'm not even sure I would notice the difference between charging and petrol, whereas they absolutely notice the difference.
It's good to compare and contrast the investment opportunity set. Now, the other key factor in venture capital investing is, of course, the founders. Now, how's your approach to identifying founders? How do you go about that, number one? And number two, is it the same approach as a VC would take, the traditional route in developed markets, or is there something, completely different that you have to worry about?
So this is where we really break protocol, I think, with the traditional VC world. And again, I think it's in defense of the larger funds, they're operating in just such a much more competitive environment that they probably can't get to know the founders as well. And when implementing a power law investment approach, you maybe don't care as much about who you've invested in. You're really concerned about where the big winners are coming and what they are. We're investing in founders who are in love with the problem and not the solution. So that's kind of like screen number one. We do believe that the kind of glue of our strategy is the people that we're investing in that are also thinking about all stakeholders. And the reason that matters is because in emerging markets, there are arguably more stakeholders than there are in developed markets. One example is sometimes the government's role in that industry is not clear. In the case of ampersand, the Rwandan government actually kind of surprise banned ICE bikes, which was great for the company, right? But had a company been playing on the other side of that, they would have been caught in a difficult situation. So you have to think about the government. You also have to think about, let's say, kind of the climate adaptation story, because where we invest will be disproportionately hit with climate change. And so, whether it's drivers of bikes or, farmers that are using specific IoT devices that our companies make to improve their crop yields, they have to be aware, the companies have to be aware of what the climate impacts are to adopt their strategy. And then finally, I think what's also really key is that they're thinking about their employees and the communities in which they operate. There are a lot of older school ways of saving money, or cooperatives and different stakeholders in transportation and other industries, or even healthcare, like health workers. And it's very important to know, who else is out there. So we think a lot about what we call this concept of conscious leadership, leaders who are engaging all stakeholders. And that's a way to screen our founders as well. But the way we find our companies is not dissimilar from the way that A16Z finds their companies. It's through a web and a network of, whether it's kind of vetted sources or individuals that source deals for us, or spotting exceptional talent and kind of waiting to see what they develop. We're not a venture studio, but we are willing to get to know early talent and then kind of wait and watch a little bit as well.
Now, to make this all work, you need the founders, you need the investment opportunity, and then you need the LP capital. So in terms of, talking with LPs and discussing, the Beyond Capital Ventures opportunity set, I'm sure they don't hear a lot of pitches on investing in Africa and India. So what sort of misconceptions or feedback do you hear from the traditional allocators?
So I think traditional allocators have largely been interested in our work. It's really, though, how they've had exposure to emerging markets that shapes their strategy and their focus on it at any given time. The reality is, like, equity strategies in emerging markets are very volatile. Debt strategies are also similarly, not as, I would say, not as low risk as one would think for credit. And the reason that is because they're largely investing in somewhat binary event type industries, whether it's like winning a large government contract or it's, kind of industries like telcos and industries that are linked to probably some of the more volatile parts of emerging markets, which can be occasionally the government. As I mentioned, Ampersand had the tailwind of this, but other companies may have headwinds of government decisions. And so when institutional allocators look at our fund, it often helps if they think about us as a more differentiated VC strategy or private credit strategy where we are lending to our VC portfolio companies because that's our core credit strategy, as a standalone versus like, this is, emerging markets and it fits into that bucket because they've likely had their fingers burned in the past. We are 100% emerging market 2.0. There's a lot of research that even investing in some of the EM indices, you're getting access, you're getting exposure to countries that you may not want. In the past, that was Russia. Some investors, obviously now that's out of portfolios, but in the past you were getting exposure to a lot of countries where maybe you didn't want that. And so what we kind of try to pitch is like the way we invest is different, and what you're adding to your portfolio is a whole market that you would not get through public equities or public or even private more corporate debt in the emerging market space. And that resonates. And as we grow in scale, we've had indications that large pension funds and some of the larger institutions would be willing to relook at emerging markets through the lens of our fund.
And then just looking at the full life cycle of an investment in a portfolio company, how do you think about exits at the back end of a deal? And how might that differ from some of the traditional VCs and then as well in your region versus North America?
Yeah, I think the way we look at exits is very similar to North American VCs, to more traditional VCs. 60% of our portfolio companies have strategics on the cap tables or as partners in the business. We look for that on day one. We also tell our founders that exits start on day one. And that means that we are always thinking about what are our exit pathways? How is this company building towards an exit? So whether it's a strategic acquisition or there is, some sort of private equity takeover of the business, as the PE world within India, as well as in Africa, or at least European PE, in some cases, that has an appetite for Africa, has grown. And then finally, because of our relational approach, we do perceive secondaries as a meaningful way for us to exit. And in our 3 exits, we actually had, in our track record, we had 2 secondaries and a founder buyback of a warrant that we had in place for a venture debt investment that really boosted our return. So we are very aware of the need to exit. I also have portfolio companies that have spoken with NYSE and the London Stock Exchange. I think it would be nice to see companies in Africa reach a level where they can list internationally and not be a mining business. And then in India, the main board and the SME board, which is a pathway to the main board, are 100% available to our portfolio companies. I think in India, we will definitely be have companies like kind of list and ring the bell. Right.
And from what I know about the Indian market, and it's pretty limited, there's a lot of retail investors speculation in the public markets. And I heard a crazy stat that the options market is actually way more active than the underlying cash equities market, which is pretty exceptional. But that said, prior to wrapping things up here, Eva, I was wondering if you could sort of discuss your 5 to 10 year forecast. What do you think is in the cards for emerging markets investing in the medium term here?
In the medium term, I think we're really looking at the greatest investment opportunity of our lifetimes. I think it depends on when an investor gets in to experience that. Now, probably I've put this on the same plane as artificial intelligence and I think venture capital are three, like for our generation, true wealth creators. And I say that because the demographics and the demographic dividend is undeniable. I'll share a couple additional stats, but 1 in every 4 people on the planet in 2050 will be African. India already has the largest working age population, and there are pretty significant demographic tailwinds with 800 million people entering the consumer class in the next 10 to 20 years. And so while our strategy may seem a little early, what we're really doing is setting up the foundation and the roots to be able to select quality in our markets. And so I think looking medium term, there will be more competition for me, but we'll have our roots down in the right businesses, and our founders will have exited. They'll be kind of continuing to refer us deal flow, and what we're really looking at is a very strong opportunity for investors also to diversify and find alpha, and frankly, also not overpay for it, but that may change. I can't predict that.
Great. Well, thanks for walking us through the opportunity set in a story that we don't hear very often, investing, specifically VC investing in frontier markets, India, in East Africa. And I always love hearing differentiated stories. You hear kind of the same old, just in the standard media. So to get your story out is pretty cool. And we wish you the best of luck in the future.
Thank you. It's been a pleasure to just talk about the opportunity for alpha and really appreciate your time today.
All right. Great. Thanks, everyone.
Thanks for tuning in to the Absolute Return Podcast. This episode was brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com. The views expressed in this podcast are the personal views of the participants and do not reflect the views of Accelerate. No aspect of this podcast constitutes investment, legal, or tax advice. Opinions expressed in this podcast should not be viewed as a recommendation or solicitation of an offer to buy or sell any securities or investment strategies. The information and opinions in this podcast are based on current market conditions and may fluctuate and change in the future. No representation or warranty, expressed or implied, is made on behalf of Accelerate as to the accuracy or completeness of the information contained in this podcast. Accelerate does not accept any liability for any direct, indirect, or consequential loss or damage suffered by any person as a result of relying on all or any part of this podcast, and any liability is expressly disclaimed.